Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure a BRRRR deal. So, very exciting topic, something that we love, especially here at the Mortgage Calculator. So, we'll get into it in just a moment. Just give us a second here to go live on all the different platforms. Appreciate everybody tuning in nice and early. We will get started here in just a moment. All right. It looks like we're live on all the platforms, so we can go ahead and get started here. What we'll do is we'll take the chat off the screen for now, but go ahead and keep dropping comments there in the chat. You can drop any questions you have in the chat as well for Jose as he goes through the presentation. So welcome, everyone. My name is Kyle Hershey. I am the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on the show is go through a in-depth loan officer training. And tonight we're going to be talking about how to structure a BRRRR real estate loan, or I guess kind of a BRRRR real estate deal in general, right? So Jose, why don't you go ahead and talk about, first off, what a BRRRR is, what we mean when we say a BRRRR, and how we can structure a BRRRR loan.
All right. So how's everybody doing? Well, that's part of the presentation, but I will answer your question exactly here. BRRRR, BRRRR. It means, it's an acronym, I guess, in a way, for buy, rehab, rent, refinance, and repeat. Right? That is what BRRRR. So that is a lot of BRRRRing has been going on for the last couple of years, built up a lot of momentum, a lot of reasons why. So let me jump right into it here so I don't get ahead of myself in the presentation on how to structure a BRRRR. R, you can't forget the last R because that's the repeat, right? That's the one that makes you the money as you are creating wealth, right? And we all know one of the best ways for individuals to create wealth is through acquisition of real estate. So, why is the BRRRR so popular? Well, we all know investors are driving the market, right? Non-QM originations have increased, right? And they have increased as a response to higher interest rates. Right? We had those borrowers that were previously pre-approved at 3% interest rate, and now the rate could be 6 or 7%. So obviously they not necessarily approved for the same amount of income. So then that takes some outside the box solutions here, right? Our non-QM, where we have our previously full doc with tax return borrower who's self-employed now says, you know what? I'm going to use bank statements instead now to qualify. So now our non-QM originations definitely increased due to those reasons. And then obviously our investors are also leading the way. They are leading the way because we have so many great investment property loans. DSCR, bank statement loans. Low property inventory for sale has made rehabbing even more profitable. So besides the DSCR loans that keep increasing in options, increasing loan to values, in some cases lowering of FICO scores, which means more ability for more investors to qualify with it. The low property inventory has resulted in a great market for rehabbers to come in, buy distressed properties or older properties, whatever it may be, and creating them into somebody's dream home. And then we all know that the rentals rates are also rising very fast. Are rising faster than interest rates, which makes fixed flip loans converted to DSCR loans extremely popular. Right? We're seeing a lot of investors that aren't doing fix and flips, even though that's what we still call the loan type, right? Because that's the short-term bridge renovation loan that I'm going to get into. But now it's more like fix and hold, right? They're like, wait a minute, this is a nice property. We're seeing some pretty good appreciation here of the value of the property, and we're seeing some great rental income. That is why the BRRRR strategy has really gained momentum, because the rental part of it mixed with the refinance part of it has really taken off. So let's cover, as I like to always empower my audience, right? Just like I like to empower my borrowers when I'm speaking with them about the terms of their loan. Let's talk about some investor terms as we discuss some of these things in the presentation. Most importantly, top bullet point there for most of the investors is seasoning on title, right? How long the property owner has been on title is what seasoning on title refers to. Now, the best options out there uh, are when we have options that require 6 months or less, which we do have, and we even have options that require 3 months, and options that let you go in with 0 months seasoning on title. And the key to this is because we're talking about seasoning on title in order to be able to use the appraised value, the current market value, for the current appraised value as a market value, instead of using purchase price plus renovations, right? That's a big deal for the flippers that are now holding the property, right? They're refinancing it to getting that cash. It has to be a loan product that lets them use the current market value, the current appraised value as a market value, instead of the purchase price plus renovation. So seasoning on title is key when dealing with your borrowers regarding the BRRRR process. Recourse loan is a loan where the borrower personally guarantees the loan, and they guarantee the loan. Um, Probably going to be on their credit report. Non-recourse loan, borrower does not personally guarantee the loan. It's definitely not going to be on their personal credit report. ARV refers to the after repaired value, which is the value of the property after it's repaired, right? Pretty self-explanatory there. As is value is the value of the property in its unrepaired state, usually what they paid for it. The renovation budget is the total cost to renovate the property. Now, the renovation budget is going to include soft costs, which are the expenses associated with the planning and development of the project, including architectural expenses, engineering, tests, and permits. And renovation budget is also going to include hard costs, which are the actual construction costs like materials, labor, and contractor overhead. And the BRRRR borrowers are usually, and it's highly recommended, that they use fixed flip loans. Even though, like I just mentioned, a fixed flip loan is a short term bridge loan, right? But now they're using fixed and hold loans, but we call them still fixed flip loans. It's a short term bridge loan, and it is designed to help investors purchase and renovate a property, uh, usually to sell it at a profit, but also to facilitate the repairs if the investor desires to keep it and refinance out of the fixed flip loan into a long term loan, right? That's the refinance portion of the BRR, right? The B is the buy, the renovate, and then which we're doing with the fixed flip loan, right? This is the renovate portion. Now, interest reserve funded by the actual rehabilitation loan is possible. What does that mean? Now, usually it's going to be for up to 6 months. So we do have these short-term bridge loans can go up to 18 months, for example, if it's a very extensive and heavy rehab that's going on. Usually they're 12 months, but you can usually get up to 6 months interest reserve funded by the loan, meaning that you can borrow the first 6 months payment build it into the loan so you don't have to have any out-of-pocket payment for at least the first 6 months. The investors usually want to get out of there as quick as possible, right? The renovators. This means no payments made, right? But it really is going to depend on the profit in the deal, right? When we're sizing up the whole fixed flip transaction, there's a certain ROI that gets calculated, and the higher the ROI, the more flexibility there is to build in interest reserve into the loan. Now, as this fixed flip loan is a short-term bridge loan, it is not a renovation loan. That's why I say it was a rehabilitation loan. I didn't say renovation loan. It's not a renovation loan because a renovation loan would be like an FHA 203K or a Fannie Mae home style. Those are renovation loans for the 203K is for primary only. You have the home style renovation. Those are conventional full-term construction to permanent loans for usually for owner occupants. There are options on the conventional side where if it's a one-unit property, it can be an investor renovation loan, but they're not a short-term bridge loan. The fixed flip loans are for investment properties only, and we have loan amounts anywhere from $50,000 to $5 million. So now that I gave you the context, what is a BRRRR? Did I get the R's right? I hope so. It is buy, rehab, rent, refinance, repeat, right? Where the rehab property is refinanced to obtain the funds to purchase additional investment properties, the repeat part. It is very important when you're doing any of these flip transactions, whether it's a flip or a hold, to plan for the exit strategy, right? It's critical. If it's a flip, if it's a fix and flip where you're selling the property, then you definitely want to make sure that you had that market analysis from the realtor that you're going to use to sell it, and that it's a nice, accurate market analysis so that there's enough profit there so that you can actually sell the property and make a little money. And if it's a hold, then you want to make sure you have a very good rental market study, because if you're going to be holding the property, especially transitioning into a DSCR loan, you want to make sure that the rental income that the property is generating is going to cover the loan amount payment that you need up to the terms of the loan. Remember, for the DSCR, depending on the loan to value, on the cash outs, we have 80% loan to value on a cash out. We have 75% on a cash out as well. So that's really going to depend on credit score, and it's going to depend on seasoning requirements. The 80% option is a 12-month seasoning requirement. The 75% option is where we have more flexibility with the 6-month seasoning, the 3-month seasoning, and the 0-month seasoning. And we also have, again, 75% LTV. DSCR is down to 1.0, and then if the DSCR is less than 1.0, actually, we have a 75% LTV also. No, that one, 70% LTV on the cash out for the 0.75 to 0.99 DSCR. And we even have a DSCR below 0.75, which is also 70% LTV. On those, 75 for the 1.0 with seasoning. With 6 months seasoning is the ones I'm talking about here. Those less than 1.0 DSCRs are going to require 6 months seasoning. The 0-month seasoning option is going to require 1.0 or above. So if you are transitioning into the loan, right, it's a fix and hold, all income types are possible, like I was mentioning. Full doc, bank statement, P&L, 1099, but only the DSCR has the 0 seasoning options. And that's why they are preferred by experienced investors that have multiple properties and definitely want that less than 12-month seasoning, because the key here is speed to the money, right? You're transitioning out of the hold, the rehab loan, right? Maybe you had a 6-month interest reserve. You definitely don't want to start having to start making payments, and you definitely want to, get the new loan and get the money so you can get the new property, right? And the whole key, again, like I mentioned, is having a option that will let you use the uh, current appraised value as the market value instead of purchase price plus renovations when you have less than 12 months seasoning. That's a really important concept here to make this BRRRR transaction work. That is the part where you're going to add value as the MLO when you're conveying this very important process. And when you tell them about your 0 month seasoning option, their eyes are going to get like big saucers. So now breaking it down here a little bit, what is the life cycle of a BRRRR transaction? Well, so now we break it down here into the B, right? The borrower buys the property with either a fixed flip rehab loan, which is the preferred option, a hard money loan, or cash, right? The borrower then renovates the property, preferably if he used the fixed flip loan. He is, it's really the only one that's going to allow the full BRRRR because now you're going to buy the property with that loan, renovate the property with the same loan. The hard money loans may allow you to buy it with a hard money loan, but then you're probably going to have to come to us and refinance your hard money loan into a fixed flip loan to get the money to renovate, because we definitely do not recommend that you use your credit cards to renovate these properties. And I know sometimes you say, it's only $20,000, it's only $30,000, but you put $30,000 onto your credit cards and your credit score is going to go from 720 to 620. And guess what happens now when you go to get the DSCR loan, right? We're going to tell you, wait a minute, at a 620, I think you can do like 70% or something like that. I think we covered that in our low FICO score daily rate show the other day. You're not going to get the 75%, and you're going to get a much higher rate, right? So don't prejudice your situation here by lowering your credit score by jacking up your credit cards because you didn't come to us first, right? Come to us first. We'll give you the great consultation on the fixed flip loan to buy and renovate the property, right? And then we get to borrower rents the property, right? So now you finished the renovation, you did it in 3 months, right? You had great subs, great contractor, no supply issues, right? And you were able to rent the property for, actually, it came out so beautiful, you rented it for more than what your realtor told you that you could rent it for, or more than whatever market study you did. And now you come back to your mortgage calculator loan officer and say, okay, Jose, I'm ready now. The flip is done. I got a borrower in the property. Now, by the way, you don't need to have a borrower in the property. If you have the borrower in the property, a tenant in the property. If you got the tenant in the lease already, that's great. But if you have a rehabbed property that is just going to be put into service because you just bought it and you rehabbed it, and it's now ready to go, and it's going to be for rent, well, we still have the option for you where we can use the market rent. No worries. We're not going to penalize you on your LTV because your property may be vacant and not yet rented if it's about to be put into service. We use the market rent for those situations. No LTV adjustment. But if your rent is higher than the market rent, right, because your property is so beautiful and you have that lease already in place, proof of receipt of the deposit and the first month's rent, and it's a new property just put into service, we can probably use then your new rental payment. They usually require 3 months, but when it's a property just put into service, right, and it's a new lease, we can probably go with the deposit and the first month rent already received to give you that higher amount of rent versus the market rent. And then the last R, the borrower then buys another investment property with the cash out proceeds from the newly renovated property. That's the repeat portion. That's why cash out seasoning is the concern, which is why the exit strategy funding usually involves a DSCR loan with 6 or less month seasoning. It's speed to the funds, right? Get the funds for the new purchase, get out of that fixed flip loan before you got to start paying money out of your own pocket, or in some cases before the loan expires, and then you have a situation. And you definitely don't want to have that happen, right? I see too often they waited till the fixed flip loan is about to expire to decide they want to keep it, refinance into a DSCR loan, and now they're in default because now the loan expired. Hopefully, you can get an extension so that, and they don't consider you being in default. That's an individual case by case situation. So please, borrowers out there, don't wait till the last minute to plan the exit strategy. Right. So now, last but not least, here some investor concerns FAQs. Right. I'm sure some of these things out there. Can I refinance 100% of the rehab? Absolutely. That's going to depend, and we can actually finance up to 90% of the total loan to cost, but all of that's going to depend on the experience level of the borrower, the flip experience level of the borrower, and their credit score and the ROI on the deal, how much profit in the deal. Those three factors are what's going to determine how high the loan to cost is going to be. But usually you get 100% of the rehab definitely financed. How much experience do I need? Well, actually, we have programs for zero flippers. But keep in mind, there will be credit score requirements, minimum credit score requirements, especially if you are a zero experience flipper. Keep in mind also, if it's a zero profit or not enough profit in the flip, combined with zero flip experience, that could also result in a no-go. Do I need to make any payments during the rehab? Well, depending on the deal profit, like I mentioned, interest payments can be worked into the loan, resulting in no out-of-pocket payments. That's the interest reserve I discussed. How much income will you need to verify? Well, no personal income is required, but the flip does need to be profitable. That is the profit in the deal is for the flip. The profit in the deal is the income in the flip. Now, here's a real common one where we cannot, this is one to stress, right? Can you pre-approve me for a fixed flip loan transaction? Well, that's almost all the way pre-approval because yes, we can review your credit and we can review your experience, but the final say will depend on the profit of the flip. So you need an actual property and the scope of work, in other words, the renovation and the ARV. So if you have a property in mind that you know more or less what the renovation work is and what the after repaired value will be and what price you're going to get it for, and your experience level and credit score, yes, that way that we could pre-approve that flip. But if you come with no ARV and no property at all, no scope of work, no renovation amount, the only thing we can tell you is yes, you have a good experience or no experience, depending what it may be, and your credit will be acceptable, but can't let you know exactly what's going to be possible until we get the rest of the data. And then last but not least, this is something we do every often at the mortgage calculator. Can I do a refinance of my incomplete fixed flip purchase? All right. So in this case, this is going to be pretty tough. If they're this wouldn't be a fixed flip purchase; it would be of their fixed flip loan where it was they already closed on it. Let's call it that, right? They already closed on the fixed flip purchase loan, and now they're actually doing the renovation. And now they've either run out of money or they're about to run out of time, right? So yes, we can refinance that borrower that purchased the property, is renovating it, ran out of money. It's going to depend now on what is it worth any more money now? The property, the ARV, is the ARV any higher now? What additional work is needed? How much work has been done? What's currently owed? They're usually going to require the borrower in these cases to bring some skin to the game, right? They're usually not going to say we're going to refinance 100% of your ongoing project. If they decide to do it, they'll do it, but there's going to be 10, 15% there that the borrower is going to have to bring to the table. which was mentioned, the in-process renovation can be refinanced, and the cash purchases can be refinanced. So if they buy a renovation cash and they start doing some of the renovation work, let's say with their own money or with the credit cards or whatever they were doing, yes, we can refinance that transaction. That would be technically a delayed finance refinancing. So, it's going to be the same questions. What's the as is value of the asset? What do you currently owe? If it was a cash deal, nothing. How much renovation has been done already, dollar wise? What's the ARV? What's the renovation budget? Experience, credit, and then we'll have the deal sized up and get the loan amount and close that puppy. So, a lot of information today here regarding fixed flip loans for both to sell the property and to hold the property. But keep in mind, the BRRRR process is where they are planning on keeping the property at the end, because the repeat portion is when they're buying the new investment property with the cash out proceeds from the refinance.
All right. Thank you, Jose. I do not see any questions here. So we can go ahead and wrap it up then. Great topic, great strategy for the investors out there, and definitely something loan officers should know about to talk to their clients about. But we appreciate everybody tuning in. Remember, we do this Tuesdays, Wednesdays, Thursdays, 7 p.m. Eastern, where we go through a in-depth training on a loan officer training topic. So we'll see you tomorrow, 7 p.m. Eastern, for the next episode of the Loan Officer Training Series with